Welcome back, best ever listeners. I'm your host, Travis Watts. In this episode of Passive Investor Tips, we are talking about a quick and easy three-step process on how to dollar cost average using real estate. Disclaimers, as always, not financial advice, not telling you what to do or anybody else. I'm going to share with you what I do. And if that makes sense, that's awesome. If it adds some value, that's great. That's my intent with this episode. So let's dive right in. So you might be familiar with the term dollar cost average. A lot of people associate that to the stock market. So if we think of a simple example, like you buy one share of a publicly traded stock, and let's say it's trading at $10 per share, and then it moves up to $11 per share, and you buy another share at that point. So your average cost then becomes $10.50 because you bought at 10 and you bought at 11. And so we're looking at your average price. And so the beauty in this strategy is, statistically speaking, as I'm sure you're aware, it's very difficult to time the market, any kind of market. There's a lot of things out of our control with the Fed and the government and policies and black swan events. And so even if you've been able to time a previous market cycle, it's going to be pretty unlikely you can time everything that comes after. So by dollar cost averaging, it just ensures that your portfolio gets the overall average price over time. Sometimes you're going to buy high, sometimes you're going to buy in a dip or at a discount, and you're just going to end up with an overall kind of fair basis price, so to speak. And while we're on the topic of stocks, I'm going to pull up a quick slide here for you guys if you're tuning in on YouTube. If not, don't worry about it if you're listening on audio. But this is AT&T stock before the Great Recession, 2008, 2009 recession. So it was trading somewhere, around $32 per share. And then at the bottom of the recession, once everything had fallen out, it was somewhere around $17 per share. So nearly a 50% drop, just using some loose math. So had you bought a share at the top and then had you bought a share at the bottom, or hundreds of shares or whatever, but equal amounts, you would have averaged out your price to about $24.50 per share. And what's cool about that is, coming out of that nasty recession, you would have recovered your portfolio in about 2 years, at least in terms of AT&T stock, as compared to 7 years, which would have represented it getting back to its all-time high again. So again, there's a lot of reasons why you might consider dollar cost averaging, no matter if we're talking about stocks or real estate. I love Warren Buffett's quote on dollar cost averaging. He says, if you like spending 6 to 8 hours per week on your investments, then do it. But if you don't, then dollar cost average. So we know this can be a valuable concept to us as investors, but how do we apply this to illiquid real estate, syndications, or individual deals that you're buying in the real estate space? So private real estate is illiquid. So whether, again, you're buying individual deals or doing syndications, there's no public market such as with stocks where you can just click a couple buttons and be in and out of a deal. So your money goes in, it usually gets tied up for years. It's a very slow moving machine. And in the case of syndications, a lot of these are closed in deals or funds, meaning you put up, let's say, $50K to invest, but then once the deal closes, you can't get back in again. So if next year you have another 20,000 you want to go put to work, you usually can't go into the same deal. It kind of depends on the structure. That's not an absolute, but the point is, how do you then dollar cost average? So as a passive investor, and as someone myself invested in a lot of these illiquid investments of different sorts, I'll share with you what I do. And the first step is I create a bank account, a new bank account. It could be in your own individual name, the name of a trust, an LLC. You do you, check with your advisors, see what makes the most sense, but you need a bank account that's going to be used exclusively for holding your real estate that you're going to be investing in. Number two, you need to fund that bank account initially. That can be just some lump sum that you put into the account on day one. Maybe you just had a liquidity event, or you're moving some cash from one account to another, or maybe you're just going to start funding that account through your active income, putting, $5,000 a month over there until you get either the amount that's going to be used for a down payment if you're purchasing your own individual real estate, or the amount of a minimum investment if you're going to be investing in syndications or private placements like I do. So I'll put a range there that's typically 25,000 to 100,000, depending on what deals we're talking about. We'll go down the middle here for simplicity. We'll say 50K. Okay, so we want to have a target amount of 50K funded in that account. So number 3 is make an investment that produces passive income or cash flow. I don't speak out about this a lot, but 90% of the deals I invest in are going to be monthly cash flow or monthly passive income. And there's a lot of reasons for this. One, I see it as a risk reduction strategy because I'm receiving capital back quicker than quarterly or annually or biannually in some cases. Number 2, it's the velocity of capital. As soon as that capital comes back and I have enough to go put somewhere else to work, even if that's in a brokerage account for $5,000, I can quickly turn capital that way. And number 3, among many other reasons, it's more convenient to live off monthly income than it is quarterly or annual income or biannual, like in the case of bonds and things like that. But I digress. Number 3 is simply to make a passive income investment. Now, you can structure this, and most syndications or private placements, you have an option to do ACH or direct deposit right into your bank account. If you're buying your own individual real estate, renting it out to someone else, you can set up through apps and different software, direct deposit as well, to where you can be paid on a monthly basis right into your bank account. I always recommend doing that. And so here's where this kind of gets to be a beautiful strategy. So we'll say that we made that first investment with $50,000. For simple math purposes, we'll say that the yield or the cash flow or the passive income is 10% a year. That means that we're collecting about $5,000 throughout the year by holding that particular investment. So what that means, and the reason this is kind of cool, we're going to talk about 2 things real quick: compounding and dollar cost averaging. So on the compounding front, when we get to do a second deal, let's say it's year number 2, we're doing 1 deal per year. So we have a bank account now with $5,000 sitting in it because that was our distributions from the first deal we invested in. So now we only need to contribute or put up $45,000 to do deal number 2 because we already have those dividends. And as we move forward and we're going to do deal number 3, now we theoretically have $10,000 sitting in the bank account from the first 2 deals that have been sending out their cash flow throughout the year. So each year that goes by, it actually gets easier and easier. It's a little bit of a front-loaded kind of snowball model. And so that's on the compounding front. Now on the dollar cost averaging front, the reason this is dollar cost averaging, if we're going to do 1 deal per year, or maybe you're going to do 2 deals per year, is the market's always changing. Whether we're talking about the stock market or the real estate market, interest rates are changing, cap rates are changing, different deals are going to be priced out in different ways in different markets. So each time we're doing an investment, we are either buying a little bit higher than before or buying a little bit lower than before. And so that's how we're effectively able to dollar cost average in the same way you can do with stocks. You can think about it this way. The average home price in America around 2012 was about $250,000. Today, it's over $400,000. So if we had said we're going to buy 1 single family home per year as an investor, we would have been buying at 250,000, maybe then 260, maybe 300, maybe 3.25, maybe 350, and then today maybe 400. And so if you average that out, our average cost might be 325,000 per single family home. So now if we revert back to our strategy and we look at this on a decade scale, kind of like that example, 2012 through 2022, and you're making 1 investment per year and you're putting, let's call it 50,000 up, whether that's a down payment or a syndication deal, and you're able to collect the 10% annualized yield, just obviously for example purposes, what that would effectively mean is after 10 years, if you think about it, in that bank account, you now have $50,000 coming in passive income or cash flow. And what's cooler than just saying I have $50,000 a year in passive income coming in is that if you're not living on that money at that point, you could be using that $50,000 per year to fund your next investment. So in year number 11, you could just use your self-sustained cash flow to make your next investment and having to put none of your own money into the deal. And so, again, that's the compounding and the power side of this. So, as I like to say, feed your investments so one day they can feed you. Never financial advice, not telling anyone what to do. Please seek licensed advice. But my friends, that is how you can dollar cost average. That is how you can compound and build diversified passive income streams. Thank you for tuning into this episode of Passive Investor Tips. I'm your host, Travis Watts. Let's connect on social media. Like, subscribe, comment, share these episodes with anyone you think could find value in them. Have a best ever week, and we'll see you on the next episode.